G'day expats, welcome to another episode of Expat Chat. Today we're episode 31. I'm joined today with my colleague friend Brett Evans, Managing Director for the EMEA region. Brett, how are you going?
Mate, all good in the sandpit. We're all good over here. It's things are looking up. I think the world's starting to normalise, and I say that in inverted commas. But things are looking good. Christmas is almost around the corner, and I'm hoping that it's going to be one of those Christmases for everyone that they deserve. It's been a tough couple of years, and whether that's getting back with families and loved ones or going on holidays and refreshing the batteries, it's going to be here before we know it.
I know it's sort of crunch time, I guess, and I mean, normally businesses start to slow down, but it's just, as always, busier than ever. But I think you're right. I think things are starting to normalise. Restrictions are coming down. Vaccination rates in most countries are starting to get at that sort of critical mass or that herd immunity. Not so much in sort of undeveloped, I guess, countries, but it's getting to that point where you're seeing a lot of developed countries start to help out those smaller countries because of the vaccination doses and those sort of things. So I think in the next 12 months, the world's going to look completely different, but ideally by the end of the year, especially in Australia, borders come down, flights are a lot easier to come back to Australia, catch up with friends and family. I know New South Wales, they've sort of started to do that with that new Premier. Queensland, they're sort of earmarking December 17th. That's when we might start doing it, which is very exciting. And then Victoria's probably not far off New South Wales. So it's a breath of fresh air knowing that maybe this is all coming to an end in the next sort of 6 months. We will always have to live with COVID. I think that's normal. Have your booster shots and those sort of things, much like your cold and flu shot, I guess you could say. But I think next year is going to look very different. And I think we're all just pretty excited about winding down for the end of the year, having a bit of a break, and then soldiering on for the next year. You're right, can't go anywhere without sort of seeing Christmas sort of decorations in most stores. Your Coles, your Woolworths, your Kmart's, your Big W's, your Bunnings warehouses. They're sort of starting to crop up everywhere now, which is quite nice to see.
Well, I just think it gives you an excuse to stop worrying for a bit and relax.
Yeah, absolutely. And I suppose one thing which I'll sort of bring our attention to for today's topic is. I think it's something that's come about, and I'll talk about a bit about it soon. But land tax and lending restrictions.
Actually, I just realised I haven't done your introduction. So for those on the call who doesn't recognise the visual or the voice of my colleague, he's James Ridley. He's the managing director of the Australian office and looks after clients in the Asia and the Americas. Some people confuse us for being twins, but we're not sure what goes on there. So, and also disclaimer.
Yeah, I was just going to say.
Yeah, disclaimer. So I've got to be different now. I'm just trying to think of this. So for those folks who are privileged and have the honour of watching and listening to us, and I say that with tongue firmly planted in cheek, you should take the same amount of attention as you would to listen to a 4-year-old discuss what presents he wants. This is just for your entertainment only, and should not be considered as financial advice.
God, I was wondering what way you were going to go then. I thought you were going to say just this is absolute rubbish what we're talking about today. But no. You brought it home strong. But listen, we'll kick into it. Land tax and lending restrictions. I'll talk about lending restrictions a little later, but land tax, I think this is one that we probably need to drill home pretty strongly, just because I think recently the New South Wales OSR, or Office for State Revenue, has done a bit of a sweep with a lot of not necessarily expats, but just probably properties as a whole. And I've noticed there's been a lot of letters that have been going out, whether it's to my clients or expats in general, and expats are forgetting to do something very important. And even most accountants that I've spoken to, their interpretation, funnily enough, of the land tax rules has been incorrect. I mean, the state, they're obviously looking at tax legislation from the ATO, not land tax. So it's very interesting when I had an argument with an accountant recently, but he actually admitted he was incorrect. So one thing which I've found is when we're living in our main residence, whether it's in New South Wales, Queensland, Victoria, that main residence is always going to usually be exempt from land tax. So, that's the main residence exemption, or the primary place of residence, PPR exemption. Every state sort of got its own verbiage on that. And now what I've found that's been happening is that we forget to update the OSR when we head overseas, and we don't notify them that that's now no longer technically treated as our main residence because it's now being rented. Now, the confusion arises because you've got one piece of tax legislation from the ATO, the main residence exemption, main residence, renting out capital gains tax-free. That doesn't apply to expats anymore, but that's sort of the confusion. And then you've got land tax legislation, which is completely different. If you're renting out your former main residence, well, it doesn't qualify for that main residence exemption anymore. It will get cut, caught out by land tax, payables and liabilities. So the issue that I've been sort of coming across, and Brett, you might have seen a few clients or a few expats.
We see quite a fair bit, yeah.
Yeah. So what's been happening is that an expat gets the opportunity to move overseas. They're now renting out their former main residence. And the one thing they haven't done is update the OSR by completing about a 3-page document to let them know that they're now renting out that former main residence. Sometimes you might get an email that comes from the local council saying, what's the purpose of this property, and is it renting out? Sometimes the agent gets it and fills it out for you, which is very uncommon. Not really, I suppose, something which would normally happen. But usually when we don't update the OSR, we can be renting out this property for a couple of years, and then finally the OSR comes around and finds out, oh, hang on, you've been overseas for 3 or 4 years. You've been renting out your former main residence, but under our criteria, it's not treated as a former main residence. It's just treated as an investment property. Therefore, we have 4 years overdue of land tax. And then we're also going to load some general interest charges on that, which general interest from state revenue officers, they're usually in double digits, 10%.
They're not kind. Yeah.
They are not. So this has been a key theme, which I've noticed in the last probably, I would say, 3 or 4 months. And I don't know what's brought it around, to be honest. I don't know whether you've had state or OSRs in each state just sort of doing a bit of a cleanse.
They are, and I think I know what brought it around is the fact that the government's state as well are laden with debt, so they're trying to increase revenue.
Yeah, I think you're spot on, but it's pretty concerning because it's not something that's normally brought about by your accountant. An accountant wouldn't know this, land tax, those sort of things. It's a state tax issue. It's not something they would pick up. It's very rare that even a solicitor or conveyancer picks this up. So again, further to that, even your real estate agent, they're not going to know about this piece of legislation. So it's something that you do need to update. And obviously the update happens once a year. But again, when you start renting out your former main residence, you do need to update that state revenue office to say that it's now being treated as an investment property. It does mean that if it's over the thresholds within each state, it's going to start attracting that land tax payable. If you're incurring that land tax payable notice in that financial year, it is a tax deduction in that financial year, even though you might pay it in the next financial year. But it's on an accruals basis when it comes to paying for land tax and claiming it as a tax deduction. So that's good. But yes, this is something that's been coming around. It's come around recently with an expat, a couple of expats actually. Someone had an outstanding bill of 5 years with interest on it. It's more than 150,000. So it's a good property, but that's an example of worst case scenario. And again, it's something that, as you said, it's obviously revenue raising because they're all in debt, given the stimuluses and everything from COVID-19. But big concern. A lot of expats are just forgetting to do so.
Yeah, look, and I think it's like we've always said, when people are about to move overseas, priority number 1 is where they're going to live. Priority number 2 is where the kids are going to go to school. Priority number 3 is planning holidays. Priority number 4, good bars and restaurants. It's lifestyle. Like we see with deemed disposal, people don't know about that. They don't do it. That costs them a lot of money. Like we see with main residence exemption, not knowing the changes that can bring and the unintended consequences that fall from that. There's a lot of superannuation, paying for insurance that is not valid as an expat. There's a lot of those sort of housekeeping issues which aren't difficult to address, but like we always say, you don't know what you don't know. And
that's right.
If you just sort of jump on the plane and wing it, they're the ones who get caught out. And, at the end of the day, the government's going to have no sympathy for them, even though those people weren't aware of it. Ignorance is not an excuse.
Yeah. Yeah, absolutely. And I mean, it's just, again, it is a bit concerning, this sort of land tax sweep, because it's mainly just the interest charges that they have no issues laying on them. You know, when they're double digits from a few years, it adds up very quickly. And people need to remember that if you own more than one property in, I suppose, a state, then all that land taxable value adds to those different tiers. So that's where you can get hit with so much. That's right. It's not per property. It is accumulative. If you own 4 properties, well, in one state, well, okay, you're going to be well over probably the tier for land taxable value. And if you're overseas and you're treated as a foreign resident, sometimes obviously depending on the state, you can get hit with an additional surcharge, a percentage. So that's the main issue that's coming around. But I guess driving home, if we are renting out our former main residence and we have not updated that state revenue office, the fact that it's now treated as an investment property, you need to do so, because if you don't, you are going to be caught out with probably a few years worth. That's right. Depending on the state you're in, just remember that different states have different thresholds. You know, Queensland, where we are right now, our threshold is 599,000 on taxable value of land. Now, taxable value of land is very different to the market value of that property.
Correct.
You could have a property worth 1.5 million, but the taxable value of that land might be, say, 500,000. And that's honestly how it can be calculated. If you're invested in a unit or an apartment, but that apartment block is only on, say, 500 square meters, you're not going to be over the taxable value of that land. You'll be well under it. You know, the value of your land might be, 80,000 based on your, the apartment. It gets split up between all the different apartment owners. So that's a really important takeaway. Taxable value of land is very different to market value. So it's just something that I've seen in the last couple of months, and I really just wanted to get it out there, because I guarantee a lot of expats, when they listen to this episode, they're going to be going, okay, shit, I need to go back and start updating that, because it's probably something I haven't even thought about.
And I think the other one too that I'm watching closely and nervous about is, previously Queensland brought in a absentee surcharge that had no carve out for Australian citizens. So right. for a year and a bit, Australian citizens got slugged. We had a lot of folks who dumped property because they were cash flow negative before they paid their mortgage.
Yeah.
Then Queensland included an exclusion for Australian citizens. But now with COVID, debt, all those sort of things, whether they're going to change it, I'm not ruling it out. I'm not ruling it out. I just think, if you're Anastasia Palaszczuk, you play to the masses, expats the minority, they can raise some easy revenue. I don't know.
I agree, because I think in the background you've also got to think of just these, I suppose, political dramas that are continuous with China and foreign investors and other things. States are always trying to work out different ways that they can penalise foreign investors for buying property in Australia or holding property in different states. So sometimes when they're updating that legislation, they don't tweak it so it says Australian citizen, just says foreign resident, which is aligned to a non-resident, which is an expat living overseas, which means you capture an Aussie expat accidentally. So they're not thinking about it from an Australian expat point of view. They're just trying to reduce foreign investment into, I suppose, land ownership, to be honest.
Yep, and raise revenue. I think it's a very good point. It's something that, especially with the overheated property market right now, the perception from government might be, well, they can afford it because their property's gone up in value.
Yeah, absolutely. And I mean, that's a good segue, Brett, into the lending restrictions that have come through only in the last couple of weeks. It was something that I talked about briefly on our other podcast with Jeremy. And what's happened is that APRA has actually had to step in. So APRA, obviously major regulator in Australia when it comes to financial institutions and ADIs,
Australian Deposit Taking Institutions. Yeah,
they're very wordy. So they've had to intervene and start capping, or not capping, they increase the minimum percent or interest rate threshold. So what that means is that previously they were running a scenario where the buffer that they would allow for was about 4%, I believe, or just over 4%. So anyone that was going out and getting a new mortgage, your serviceability was factored off that interest rate and a principal repayment. Now they've increased it to 5%. So with that lending restrictions, it means it's ideally slowing down the amount of investors going out and buying property, especially on the east coast of Australia, just because the property market in the last 12 months in most blue chip areas has done double digit figures, and it seems to not be slowing down at the moment. So that's the concern that APRA's had to send in and say, okay, we need to sort of cool off this property market a little bit. Why don't we make it a bit harder for investors and I suppose, main or homeowners to turn over their property and slow it down a little bit.
And they did it once before. They did it back in 2017, and that's what caused Melbourne and Sydney to fall. I think it was about 12% in a year. So they tapped the brakes in a big way there. I think that was at 7% from memory, not 5%.
Yeah.
So it gives them ability to keep ratcheting it up. And I think we'll continue to see that, when we look at reports around the world on the Australian property market. So not a biased opinion and feathering their own nest, but impartial views. The International Monetary Fund, the World Bank have all issued reports in the last month highlighting grave concerns about the Australian property market and how it is just teetering on that edge. And, you and I have been talking about this for the last year. The biggest problem from we see is serviceability. It's all down to serviceability. You've got a whole generation who's never paid a mortgage rate greater than 4%. So the capacity for them to be able to, maintain their mortgage payments as interest rates rise, which they will, is questionable. But then you've also too got the scenario where wage inflation hasn't been matching the rising living costs, whether it's inflation, whether that's the property prices and those sort of things. So, a lot of question marks.
Yeah, absolutely. And I mean, some good data that you can pull out from the ABS is sort of a lending indicator where it tells you the amount of loans which have been written either for owner, occupier or investor in the billions. So, the average keeps changing every month, but I suppose from going back, all the way to 2018, it's slowly been increasing, from about 10 billion per month. And now we're at a stage where most months after January 21, it's above 28 billion new loans get written every month, which is crazy, the amount of debt that's going into. This isn't refinancing. This is new loans.
New money.
So when you've got, that's right. When you've got a loan book that's increasing that quick, well, then the property market's also increasing that quick in terms of value, but that value might be overstated. So there is a bit of a concern that obviously the property market's running too fast, too quick. And I suppose the security that supports that, being the asset itself, isn't actually worth, what those loans are being written for. So a bit of a concern that, we're going through this bull market right now in the property market. It needs to slow down, ideally probably by next year when they start to turn on maybe the interest rate tap and they increase the cash rate. But I don't know if we're going to see that happen until maybe start of 2023. What are your thoughts, Brad?
And a lot of the central banks around the world saying the inflation we're seeing right now is transitory. So it's not endemic in the system. And I agree with that. If you look at anyone who's trying to ship an item from one country to the next, they know that they're paying through the nose for shipping. So that's going to flow down through the cost of the good that's sold. I think the biggest thing out of all this is, and look, there's been a couple of questions about the word stagflation, and for those out there who don't know what stagflation is, it's virtually when you get inflation, but without the commensurate economic growth. So costs are rising, but no one's ability to partake in that growth is there because they're not growing themselves. So stagflation is a concern. I don't think it's a concern just yet. To me, the central banks have a great track record of overshooting the mark when it comes to stimulus. They'll just keep pumping. We saw that through the GFC. US Fed should have tapered, in 2011. They didn't start till 2014, and that created that bull market at the end. And I think they'd rather have a bull market and that hype than get into inflation and stagflation now. So even though you're seeing central banks talk about tapering, no one's done it in any great degree. The interesting one was, and I think it's going to be a great case study to watch, is our friends over in the seventh state, New Zealand, across the Dutch, as I say, because they actually raised rates last month. So
they did.
It's going to be interesting to see how that plays off, and I think a lot of countries are going to be watching that one closely because they're really, especially from a comparison point of view to Australia, they're probably the first country with a similar economic demographic that we do to raise rates. So I think if that is shown to cool the property market down but not slow the economy down, then there's a pretty good chance that the RBA will bring forward their forecast of a rate rise in 24 to 2022, 23.
Yeah. I mean, it was amazing when they were saying that they won't touch interest rates or the cash rate until the 2025 financial year. I mean, that's just ridiculous when you think about it, especially the way the property market's going. You'll be buying a property right now worth 500,000, and if at the current trend, you'll be selling it in 5 years' time for $1 million. So it doesn't make sense, especially when you're right. Wage inflation isn't there. Wages haven't really gone through a big period of growth in Australia, probably for almost 10 years, to be honest. So with the cost of living keeps rising, we're well behind the eight ball. I mean, how can they light that fire, get wage growth, obviously tracking back up, much like other countries? It's a tough one.
To me, the 2024-25 rate call is a nonsense thing. Especially with the amount of macroeconomic issues we're dealing with right now. A lot can happen in the next 3 years, 2 years, 1 year. There's so many things going on in the world right now, as well as under the umbrella of the pandemic. You've got China rattling in the saber with Taiwan. That is a big concern. Obviously China's issues with respect to going to renewables too quickly and running out of coal. Their annual consumption of coal is 4 billion tonnes a year. And so far they've only been able to import 300 million because they've stopped importing from Australia, and they're mainly relying on places like Canada. So the prices for coal went through the roof. But then also too, they're paying more for less. So they've only just now reversed that, because essentially what China had to do was tell factories, okay, you can only operate through the night. You don't want to operate through the day because we need the power to put electricity in homes.
They're having rolling blackouts.
And that's been a common thing for China for the last 10, 15 years, but not for homes. Even homes were going through blackouts as well too in some of the second and third tier cities. So, is that going to be a bit of a handbrake on China's economic development and growth? Probably.
Yeah, I think so, especially the next 18 months. Definitely.
Yeah, and then you've got scenarios like just the cost of commodities. You look at LNG is a great example. So, the big ships you see with the LNG carriers with like balloons on top. This time last year, that ship fully laden was worth $10 million. Now, this year, right now, this month, that ship is worth $200 million.
Yeah, it's amazing, isn't it?
So that is going to flow through to economic input costs and all these sort of things. And if, people's heating bills are going up and all that sort of stuff, but their wages aren't, that's where we're going to start to get that. And now that's what they're worried about, the stagflation side. So look, it's going to be a fascinating 12 months to watch. It's going to be interesting to watch this episode next year, just to see how it all plays out. Do I think doom and gloom is around the corner? No, I don't. Do I think, I think where it's different this year than, say, GFC is corporates were laden with debt. And they never got back to those same high LVR, those high debt levels. And so to me, as long as the corporate's okay, they can hire people, they can pay wages, life goes on. It's when the corporates fail, people lose their jobs, and then disaster ensues.
Yeah, that's right. I think a lot of big lessons were learned from the GFC, where most corporates, they run somewhat conservative debt to equity ratios now, which is good.
In the 30s instead of the 50s and 60s and 70s.
That's right. And they're not being called on as aggressively. There was always, I suppose, that recent concern around Evergrande. I don't think we've seen the end of that, to be honest. I think that'll come back around, and we'll just have to see if the government intervenes in China, just because of that contagion effect. Yeah,
they'll nationalise that business. It'd be like pretty much all developers in Australia going bust at the same time. Yeah,
exactly right. I think they had over 1 million apartments or homes that hadn't been built yet. It's ridiculous. And obviously employs indirectly, I think, over 300 million people. So I think you're right. I think it will have to be nationalised. And I mean, taking a step back, coming back to Australia, I wonder what our GDP growth figures or decline figures will look like, given that we've had, especially for September, I don't even know if they've been released yet, to be honest.
No, it comes out later this month, early next month.
Yeah, exactly. It'd be interesting to see if that's contracted because of the lockdowns for New South Wales and Victoria.
It would have to.
Yeah, you'd think so. I think that means theoretically we'll fall back into a recession because it's two quarters that need to
Well, no,
contract.
the second quarter we just snuck through, and there were some surprising figures in there. But the only thing that saved us was the spike in iron ore prices above $200 a ton. Now, iron ore's collapsed in the third quarter, which almost guarantees us to have a negative quarter. The big question is going to be is the October to December quarter, the fourth quarter, which we know we find out in January what that looks like.
I think that'll be growth because you look at the southern states; they're all slowly reopening. I think
is it too little, too late? If you look at Victoria, they still haven't announced. New South Wales is will open up now. They've got not quite 3 months. They've got 2 and a bit months to really turn things around. But there's a lot of commentary right now about the soft underbelly of SMEs, small businesses. No one really knows the data, and the data is a lagging indicator. And it's not until you come out of your lockdown that you notice how many businesses have gone under and what that looks like. So people, yes, there is a massive spending capacity by Australians because people haven't done it. But to me, it's almost a barbell effect. There's a couple at the ends who've done very well financially out of lockdown, out of COVID, or through COVID, I should say, not because of COVID. But I think there's also a lot in the middle there that you don't hear about. And they're the ones I worry about, because are they going to have the capacity to start spending like crazy once lockdowns finish and Christmas comes up? And I mean, the retail numbers will show. They don't lie.
No, exactly right. That's a tough one because I guess one thing that interests me is just whether they always, chief economists, they keep talking about this excess or spare capacity, all this savings on the sideline, especially in the US. In Australia, a couple of billion compared to pre-COVID, and then in the US, I think it's just over $1 trillion. So when you've got that much spare capacity, you would think that when you look at most share markets, GDP growth, you'd think it's going to switch into a gear next year where it's just going to keep going for the next couple of years because of all this spare capacity.
But to me, averages are dangerous, like we always say.
They are.
It's not $1 million or $1 trillion or $1 billion divided by every single person. There's some who have a lot, and then there's the others who don't have any, and that's going to be an interesting demographic to watch. Which states, which cities, which sectors are the ones that do well, don't do well, because then we'll get a true understanding of what's going on. So.
I think you make a good point there as well. I mean, the SMEs, they're the ones that you don't get enough data on, and it's mainly what we're hearing from the big corporates. But the big corporates we know are normally going to be actually okay. It's the SMEs, the mum and dad businesses, which keep this country running, which there's just not enough data on. And we saw through the real painful parts earlier in the year down in Victoria, New South Wales, these businesses were just going bust because obviously the same kind of COVID relief wasn't there anymore. The insolvency rules have changed, I think, in most states again.
Rental protection.
Moratoriums. So I think you're right. I think we've had that sort of W-shaped recovery from an economic point of view, especially when we get some hard data coming out from, I'd say, the southern states.
No, I agree, man. I think it's a good point to leave it on there. Not that we want to leave it on a question mark, but it does highlight, the next 12 months and certainly factors in people's understanding of how to manage their assets, how to manage the cash flow.
Yeah, that's right. Absolutely. All right, Brett. Well, thanks for your time, mate. I'll let you kickstart your day. It's been lovely connecting.
Awesome to see you, mate. Good to see you.
You too. Cheers, mate.
Thanks, mate. Bye.